Hey guys, it's Jeff from the Brantford Realty Group here. Thanks again for tuning in. Today we're here learning more about mortgages, and I'm here with Jarek from New Door Mortgages. Jarek, how are you doing today?
Hey man, how's it going? Thanks for inviting me on here.
Yeah, no problem. Thanks for joining us. So today we're going to be talking about how to access home equity. Everyone's been sort of asking my clients, myself, we're all interested in how do we access this money that we now have in equity from our home because the prices have just been going absolutely wild and things have been selling for more and more. So I know a lot of people are saying, how can I access this money and use it to either invest or just in case of emergency. So what are some of the options people have when thinking about accessing their equity?
Yeah, great question. So we generally have three main options. We have the refinance route, we have the HELOC or the home equity line of credit route, and we also have a second mortgage option.
Okay, and out of those, which ones do you think is the best, and what are the advantages and disadvantages of each?
Good. So they're very, very different in what they are. A refinance is essentially going to be a brand new mortgage. So you're going to be breaking your existing mortgage and getting a new one. What that means in terms of drawbacks is that generally when you break your first mortgage, there will be penalties. Whether you're in a fixed or a variable is going to dictate how much of that penalty is. And because you're establishing a brand new mortgage, there's also going to be lawyer fees and that kind of stuff. So those are kind of like the cons of the refi. But again, it allows you to take money out. The pros of that is because it's a brand new mortgage, you're going to be having probably the lowest interest rates out of all three options. And so if you're taking out a large chunk of money, you definitely want to be paying lower interest rates on those. So that is what it's good. You also only have one payment. So unlike the other two, where you might have two separate payments, this is one payment. It's going to be really good in that sense. The second option is going to be a HELOC or home equity line of credit. That's going to usually be a separate thing to your mortgage. Depending on if you establish this at the start of your mortgage, it might be combined into a kind of like a step program or like an all-in-one program. Or you could have a HELOC that's standalone. Now, those will be a little bit different, but they again allow you to access your money from your equity. They'll still have a little bit of a higher interest rate than a refinance, but definitely a lot lower than our third option. One of the pros of it is that it's readvanceable. So as you kind of pay down that balance that you have, that money will become available as well, unlike a refinance or a second mortgage where you basically just pay down.
Mhm.
That's also a little bit of a con because when you look at a HELOC, they actually don't have any amortization. So the payments are interest only. So you have to be really, really good with your credit to make sure that you don't get any kind of financial trouble as you move along. And the third option is going to be a second mortgage. And second mortgage is just that, it's a second mortgage. Usually there's a little bit more risk involved. And so the interest rates that you're going to be getting on those are going to be quite high. In some cases, some of them are a little bit lower. It depends on if you're with the same lender, what your mortgage structure is, all that kind of wonderful stuff. But you can expect higher interest rates than the other two offerings. Because it's a brand new mortgage, you will be paying legal fees, appraisal, title insurance, and so that can get a little bit pricey. But again, another option to take your money out of that equity. And it's a really good option if you need a little bit more equity. There's a little bit more room for lending when it comes to a second mortgage.
Mhm.
And also, this would be a good option for people that might have bruised credit. If you had some financial troubles in the past, some minor ones that you had some late payments, this would probably be your strongest option out of the three.
Okay, now you're dealing with the mortgages every day. What direction do you see people mainly going? Are they going refinance? Are they going home equity line of credit? Or are they doing the second mortgage option? Which one seems to be the more popular choice right now?
That's a great question. So if we're starting out with a brand new mortgage, definitely I'm going to be asking the questions like, what is your plan? Are you going to be investing? Because if I know that up front, then I would just set them up with a mortgage and a HELOC together at the same time. So they don't have to go through that. And essentially, there are some products that as you pay your mortgage down, the limit of your HELOC increases. So that's a really nice tool. So if you had that set up right away, that is a great position to be in if you wanted to access your equity.
Mhm.
Sometimes, again, you might be asking for a little bit more equity and for a lower payment or bring that one. So I would say overall, if anyone was to come to me and say, hey, I don't have a HELOC, or I need something and I need a way to get my money out, refinance would be the way to go. It's going to be one payment, lower rates, and generally it's going to be, a pretty good situation for the clients. The one thing that you need to consider, and this is something that we do with all of our refinances, is we do a cost benefit analysis, because those fees to pay to break your initial mortgage can be quite substantial. So we have to figure out if it's going to make sense, and maybe if we have to move to one lender or another, and we could do that all during that refi.
Okay, now when they're, say, giving their mortgage broker a call or giving you a call, is there things that they should be aware of, that they should let you know ahead of time, just in case, just to mitigate any problems that might come down the line?
So with any kind of mortgage application, at least from our end, is that we underwrite the deal every single time before we even send it out to a lender. And that means we ask for all the documents up front. That will be income documents, pull a credit bureau. If you have any other kind of payments or whatnot, if you own a property, we'll ask about those things. And so we get all the information that we need to ahead of time, so that there won't be any kind of hiccups going forward for the most part. The one thing that we can never control is the appraisal value of the house. So that's going to be what we're basically stating in our application, that your house is going to be worth this much. The lender will usually order an appraisal, and the appraiser is going to come out, say, this is what your house can be valued based on comparables in the market. Depending on that, if it comes in lower than we thought, then we would have to adjust our numbers. And so that's one thing that we can never really account for until it actually happens. Okay,
and I know another question that a lot of people will be asking is, how much of this equity can we access with each one of these options? So walk us through that.
Mm-hmm. The refinance can go up to 80% of the value of your home, again, based on the appraisal. So that's going to be a hard stop for all lenders. The HELOC, again, is going to be 80%. There could be times where it's a little bit lower based on credit or your financial situation with that lender. Some will only go up to like 70%, even lower. So we have to really look at what the lender is going to be offering you. And there's a kind of complicated, not really complicated, but there's a calculation to figure out what the max amount of HELOC that we can get from that. So we can definitely take you through that. And then the last one is going to be your second mortgage. There you can get a little bit more equity, but because there's more equity available for the taking, it's going to be a higher risk, and higher risk for the lenders means higher rates. So keep that in mind.
Okay, so if you're paying more you take. Okay, well, thanks for answering the questions and being here with us today. I learned a lot. I'm sure everybody else did. Now, I know if every person's situation is different. So, guys, if you are thinking about refinancing or accessing some of that home equity, reach out to Jarek. He's a great guy. All his information will be in the description below. So again, thanks, Jarek, and really appreciate you joining us.
Thanks for having me.
All right. Take care.
Bye, everyone.